Markets, futures indicating we could see a higher opening this morning, but of course nothing to the tune of what we've been seeing on the downside. The Dow fell more than 500 points yesterday on global growth concerns. This morning we're looking at the market up 81 on the Dow, 29 higher on the NASDAQ. This is the Federal Reserve is beginning its two-day policy meeting today. Officials are expected to announce they will raise interest rates tomorrow. Joining us right now to talk more about all of that is Barry Bannister. He is Stifel, head of equity strategist. And Barry, it's good to see you today. Thanks so much for joining us. What's your take on what's been going on with these markets down so much, such nervousness?
Look, I know that trade and politics grabs a lot of headlines, but they're background music. The lead singer in this band is the Fed. We've had three concerns this year. One is our earnings estimate around mid-year was a 6% below the average of sell-side strategists. Second, we knew that interest rates in a real sense, which is the interest rate after inflation, as it began to rise off a real low level, the PE ratio, the price to earnings ratio of the market would come down. And the third thing is, I think the Fed's making the same mistake they made in the second half of 2014 and all of 2015, which is that their interest rate policy is diverging from the rest of the world. So that's been pressuring the market.
Yeah, I mean, the Journal this morning, as Dagan noted earlier, has an editorial commenting on the impending Fed decision. The article is titled, "Time for a Fed Pause." And the article writes this, in part, the right answer is to ignore the politics inside and outside the Fed and follow the signals that suggest a prudent pause in raising interest rates. Get the monetary policy that best serves the economy, and politics will work itself out. I assume you agree with that. Do you expect the Fed raises rates tomorrow, and how many are you expecting in 2019?
I think the Fed will raise rates, but we see a deceleration in the economy, and that's pretty normal as the economy expands for a long time. Think of a car going from 65 miles an hour down to about 40 or 45 miles an hour. That's the order of magnitude of the slowdown. I do think the Fed will pause, but that would be after rate hike tomorrow. One thing to consider, though, is that I actually think by 2020 they unwind the rate increase of September 26th and tomorrow and have to cut rates. But that would just be normal operations of policy as the cycle matures.
Next year, you think they'll cut?
Well, that would take a while before they cut rates. Okay. But what we're seeing right now is that they're... Yeah, well, we're talking about weakness in 2020 when the fiscal policy stimulus really wears off.
Understood.
And the economy will be in a more advanced state.
Steve Forbes.
Barry, in terms of the Fed has been signaling these interest rate hikes, especially this one, for months and months. Why would the market suddenly react when this has been on the table and the Fed's made it clear what's going to happen for months and months? The market always anticipates the future. Don't you think it's other factors that are weighing on the market, not just the Fed, which told us months ago they're going to raise the rate this month?
Yeah, we've had as I said, the lowest target for earnings next year of all the sell-side strategists, and the second lowest price target at 2,800. So what we've been discounting is the earnings weakness and the valuation compression. But I do think earnings will grow next year, albeit low to mid-single digits. And I think the price-to-earnings ratio will stabilize. So things should start to get better. But right now, the market's been weighed on by simple math, earnings, price-to-earnings ratio, and interest rates.
Hey, one thing I just wanted to point out that the Journal mentions in the editorial, that there's this kind of knee-jerk fixation on short-term interest rates and what the Fed is doing, because in history, that's what we've focused on. But this is a historic expansion of the balance sheet. It was unprecedented during the financial crisis. And the Journal editorial page writes, the larger argument, it's not just that inflation is contained, that the global economy is slowing, that the larger argument for a pause is the Fed is unwinding the largest monetary experiment in modern history. Central banks move around the world, moving away from the multi-trillion-dollar bond purchases, which we saw in Europe just last week, and zero interest rates. What is the normal interest rate in this post-crisis world? We don't know, and we doubt the Fed does either. So it's been focused on the balance sheet, and that's what the Fed should be doing in terms of pausing, according to the Journal.
And that goes against the feeling the day after the Powell speech, right, where people were surmising that he was basically saying, we're at neutral. We're close to neutral.
Which the Journal some days later wrote, hey, because again, they're kind of the bullhorn for the Federal Reserve. And they warn the market got it wrong. He said that he was close to the range of being neutral, which is 2.5 to 3.5%. So we're at 2 to 2.25 before the hike.
That's not what Ray Dalio thinks.
Hey, Barry.
We're near neutral, but we'll see. That's the debate.
Barry, I was surprised by your comments of expecting a slowdown next year. Is that with with growth below 3%? Is that with the loosening of the labor market? Where do you see this slower growth coming in?
Yeah, I was talking about nominal growth. I'm in the view that the Fed is actually failing its price stability mandate, and that gives them an excuse to pause. They'll probably do pauses on a quarterly basis with renewals. I doubt they're going to commit to any sort of full-year view. But right now, I think inflation will pull back, and that would push you down towards around 3.5% nominal GDP and about 2.5%, maybe 3% industrial production growth. And S&P earnings tend to be, this is S&P 500, tend to be more cyclical than the broader economy because larger capital-intensive companies are publicly held.
What about the China fight? You're expecting the ceasefire at the G20 meeting with China to fade?
Well, one of the problems with the market today is a vacuum. We don't have a lot of information. In other words, during Bush 41's funeral, the Fed's testimony to Congress was canceled Wednesday 2 weeks ago. So the Fed went into a quiet period, and we have absolutely no idea what they're thinking and doing and talking about. The second thing is these 90-day renewals on trade talks are not something into which the public has much visibility.
That's true.
So in the absence of information, you've got a vacuum, and when you have a vacuum, prices fall.
Yeah. All right, Barry. You do like consumer staples. You say healthcare, utilities, and telecom because you think bond proxies are better in this environment.
Yeah, Maria, when I was on your show a couple weeks ago, I said the 10-year yield would fall. It's come in from about 3.25 to 2.88. I think that thing could fall down to around 2.7 and invert the 10 to 2.
Wow.
And when you look at the 10-year minus the 2-year yield, what will happen is the Fed will be forced to pause for longer. And if the Fed tries to ignore the yield curve, I think they'll be making a mistake. They made excuses for why the yield curve didn't matter in 2000 and 2007. The whole world is a carry trade. The last thing you want to do is invert the curve.
All right, we'll leave it there. We'll be watching, Barry. Great insights from you. Thanks so much.
Thank you.
Barry Bannister from Stifel there.